Let's go now to our friend Beimnet Abebe from Galaxy Trading. As always, Beimnet, welcome to Galaxy Brains.
Thank you for having me.
It's great big week in New York for
Absolutely.
Galaxy. I've already talked about this on the intro, but it's Galaxy is planning to list on the NASDAQ on Friday. That has everybody here very excited, but we're not going to talk about that. Let's talk about markets. Bitcoin holding up in the over 100K now for almost a week. Equities still chugging along positive. China, some headlines about, a little bit of thawing in the U.S.-China angry trade war. I saw something like China's lifting export restrictions on some American stuff, and, they're meeting. CPI came in soft.
Correct.
Tell us how the vibes are in markets.
The vibes are generally very good because stocks are ripping higher, and they have rallied almost 25% from the lows, and you are talking about an S&P that's essentially unchanged on the year, even though we've overturned decades of trade policy and have taken a very tumultuous path. So vibes are generally pretty good, particularly amongst the retail crowd that participated heavily in the dip buying.
They bought the dip.
They bought the dip and are now sitting in a ton of profits. The institutional community, however, is a little bit more, let's just say, less happy about
cautious.
This situation.
So they missed some of the dip, probably.
They missed a ton of the dip. And, in terms of the positioning data we've seen amongst the institutional crowd, positioning was a 2 out of 10.
So they mid-curved it, at least for now. I mean, we don't know where this goes in the future, but the sort of the left curve looked like the right play.
The left curve was absolutely the right play.
You've been talking about this for years now on the show, but about how retail has been conditioned to buy these dips since the great financial crisis, and they've been rewarded for doing so.
Every dip since the GFC has been
because we've continued to make all-time highs.
Correct. And so really, what it comes down to stop the momentum that stocks have, you really need a recession, right? And if you don't get it, then just the passive buying flows alone kind of just drag you higher. Stock buybacks are now back in full force, right? I think AMD today or yesterday announced a $6 billion share buyback program. Essentially all of the Mag 7 has buyback programs, I believe. And so, the drift in stocks is back to just being a grind higher.
Yeah, we're only about 4% off the S&P's all-time high.
Yeah, which is nuts.
I mean, do you think we're going to see all-time highs?
It's possible.
There's got to be some resistance there,
I will tell you
right?
that we have crossed the threshold of fair value, right? If you assume the S&P needs to trade on roughly a 19 PE.
Yeah.
Right, and you assume a healthy amount of EPS growth, call it 5-6% EPS growth, and you slap a reasonable multiple, that takes you to right around 5,900, and we're trading closer to 5,950.
Yeah.
But the positioning metrics are still suggesting that there's tons of room to add.
Because I was going to say, if retail has been buying stocks, but institutions, just as a categorization, haven't, or presumably if you get back above all-time high, they're going to want to pile in, or at some point.
It's possible. It does feel like
the dominoes do start to fall. Maybe they don't all, but then a couple do, and it goes higher, and now you're in a pain trade by not being long, or as long as you should be.
Correct. And what you've seen in the market is animal spirits, essentially.
Yeah.
A lot of the popular retail names have surged back to highs. Names like Palantir and Tesla. Right, those stocks have tremendously outperformed, and it's just hard to look at those things go up and and not want to participate.
Yeah,
so
not at least on the S&P.
Yeah,
right?
Correct. And so you've got a dynamic where positioning can take us higher, but I do think the fundamentals
we're stretched.
Yes.
Yeah.
And you're overbought on 10 technical indicators almost.
Yep.
I think S&P RSI is right around 70, which is your overbought territory. And we've essentially just gone up in a straight line for 3 weeks.
Yeah.
And so it feels a little scary up here.
One thing that's interesting is seeing Bitcoin, which sort of moved kind of not ahead of the 3 weeks, but over the last week or so, sort of moved first. Then when stocks were performing really well on Monday of this week, Bitcoin and ETH were selling off a little bit.
Yeah.
And then on Tuesday, Bitcoin and Ether were trading really well, and stocks were kind of selling off a little bit. And now they're both stocks are up slightly today, doing fine, and Bitcoin's kind of flat. Like, has there been a relationship? Is Bitcoin a leading indicator at all, or is it just are they all beta again on risk? Because gold is down relatively
A lot.
a
Yeah.
lot.
There's, everybody's in risk on
So now
mode.
now Bitcoin was doing decent on the gold trade for a little bit when it was trading like gold, and then now it's doing well on the risk trade.
No, I still think fundamentally it's a risk asset.
Yeah.
And I think when retail feels good, they pile into Bitcoin.
Yeah.
And you've seen, you had a healthy amount of ETF inflows
A
like
lot.
a
We're
week and a half ago.
cumulatively
Yeah,
cumulative net flows are at all-time highs. So
correct. And the corporates that buy Bitcoin, like their
They've been buying.
multiples are staying pretty constant.
And new ones keep being announced.
Correct. And the Cantor one, like, just announced a $500 million purchase of BTC.
Right.
And MicroStrategy in their last earnings re-upped their ATM facility by $21 billion.
Yeah. Wow.
And so
Wait, so that was their 21-21 plan, and did they already do it? And now they're doing another one?
Correct. So they finished the at the money offering.
But it was going to be over 3 years initially.
Correct.
Well, he's buying at a record pace.
Buying at a record pace, and I don't see it slowing down at all.
Yeah.
Because it seems like what's happened basically is that the floor on the stock market has gone up because of the trade relief.
Yep.
Right. And so if stocks are going to stay healthy and the market's going to stay healthy, then I think this, corporate strategy can continue for a little while longer. But yeah, the other thing that kind of sticks out to me in the market right now, though, is with this rebound in risk, you've obviously had a repricing of the rate complex. And so you've gone from about 100 basis points of cuts priced into the December meeting, kind of at the depths of the equity correction, to, call it like right around like 55 bips. So
Wow.
2 cuts, right? So you've halved the amount of, pricing that you've had for this year. And now you're starting to see a little bit of a spillover into the back end of the curve. And right now, 30-year yields are approaching 5%. You are at 4.96 right now.
And the 10 years at
Around
4.5.
Yeah.
Yeah.
And so, back end bonds have started to sell off. That might be a little bit concerning because, again, that's financial conditions tightening, right?
Yeah.
That's mortgage rates going up. That's financing costs going up for companies. That's, debt roll costs going up. And so, there is a meaningful impact to interest rates moving higher.
Right.
And so we'll see if that kind of balances out the risk on theme right now. But I do think that 5% threshold will, grab a lot of headlines, and, we'll see how the kind of market reacts to it.
Yeah. Well, and building on that, but also back on the equities and crypto side, let's pour some cold water. What is the bear case in your mind? Maybe it is rates higher as part of a tightening of conditions. I mean, rates higher is its whole other story. Maybe we'll talk about that next week a little bit. But about, they're trying to get those rates down, and it ain't working yet. But what is the bear case for the rest of the year on equities and Bitcoin?
Correct. So if you assume that the baseline tariff rates are, if you just take the Britain and the China stuff, it's like 10% minimum and like 30% on the high end, plus the tariffs on steel and aluminum. Like, that effectively raises the U.S. tariff rate, by 15%, right? And so that is effectively, a tax hike on consumption.
Call like 15% average inflation.
Yes. So that basically by that 15%, we mean that the average tariff
Across
rate
all of the tariffs.
is going to go up by
by obviously it's good specific, it's country specific, but in general, let's say it adds 15% of cost for consumers and manufacturers in the U.S. Yeah,
and so
that's a lot.
Effectively, like I don't know if this is factual or not, but I saw it on TV. I think Paul Tudor Jones cited the statistic, but it's effectively the largest tax increase since the 60s.
Yeah.
Right, and that does need to filter into the economy,
to be absorbed,
and that should put a drag on growth.
Right.
And so that's kind of your bear case. And then if you That's like your base bear case.
I was going to say, then you've got like the student loans
This
and
11 million student loan borrowers as of last week were officially in default.
so now they've got to pay or they get in
and the
trouble.
Department of Education
So
is
they
now
can't
collecting.
buy as many other things in the
Correct.
economy.
So,
Yeah.
I mean, that's, that's depending on who you are, it's a couple $100 that you are now not spending on consumption.
Yep.
And that's a drag. That also impacts credit scores and the availability of housing to those people. And so there is kind of a knock-on effect. And then we've also seen cracks in the labor market. I think Microsoft today or yesterday
They said
announced
3% across the board, right?
3% across the board.
Yep.
And so if you see, trade flow going down, that's going to impact things like truck drivers. We've spoken about AI, as well as folks, and enterprises get more in tune with, the benefits of AI. That should lead to a smaller workforce.
Mm-hmm.
And so, there are things that are concerning. But again, like with stock markets this high, there is a wealth effect to also think about. And again, my favorite stat is, the top 10% of income earners who tend to own assets as well comprise 50% of consumption.
Right.
And so, when those people start to feel good, like the economy holds up okay.
Right.
And so, but the other kind of, elephant in the room is these trade deals aren't like signed and done.
That's right.
Right. And Trump and the administration can change their mind.
Or it could, or they could just fall apart. I mean,
correct.
These are tricky
And
negotiations.
And they normally take years, and there's a lot of like national security concerns and things of that nature. And so you are kind of relying on trade policy not extending too much further than what people are currently expecting, which is that 10 to 30%.
And that may not be good to rely on. We don't know, right? Correct. They're not inked, and it's kind of it's kind of vibes capital management little bit, right? The vibes seem good. The headlines
fantastic.
are good, but if you think more deeply about the trade headlines, if you think more deeply about them, to your point, they're not inked. They're still sort of like you said this a couple of weeks ago, but like they're sort of ping-ponging on headlines.
Yeah.
Right now, the vibes of the headlines are mostly good on trade, but that could change. Yeah.
And then the other thing we touched on it's the rate stuff, right? Like if the Fed's not going to be cutting because activity is just fine, right?
Yeah, they don't have to cut.
They don't have to cut, and that is going to put a drag on things as well. But right here, right now, there's still a ton of length that could be added to equities, and people generally on the institutional front and the foreign holders front are underweight relative to where they could be.
They've been doing the European defense stock trade and these other trades because they thought it was going to be doomsday.
Yeah.
But now it's not.
But I do think that the structural move away from owning U.S. assets is really in the early innings.
Yeah.
Right? There are a ton of, real money, like real dollar asset reserve managers that have a ton of rebalancing to do.
Right.
And that happens over time. But, I would think that at some point by the start of next year that the dollar will have sold off a lot more.
Interesting.
Yeah. And that's the color we're getting from a lot of, major FX desks, which is like, people are still far offside.
There's more shoes to drop.
Correct. And that's just, you just think about it, there's a lot of shoes to drop just to get to market weight. Like if you're overexposed and you need to get back to kind of market weight in U.S. assets and U.S. dollar in U.S. dollars, basically, like just to get back to neutral, like there's a ton of dollar selling that has to happen.
Interesting. All right, my friend, Beimnet Abebe from Galaxy Trading, thank you so much.
Pleasure.